Live on YouTube. Very happy to greet all of you and welcome you to our Law After Lunch today, which is on banking law, and we are very happy and honored to have a guest from Poland with us, a colleague, Tomasz Gwóźdź, who is assistant professor at the University of Silesia in Katowice, and is here on finance, and we should be thankful for that for the European Union on Erasmus, if I see it correctly. Erasmus is always a great program for staff exchange and student exchange, of course, and we are happy to have you here and thankful for the European Union to have this program that enables us to get a perspective from a different country, of course our neighbor country, on an issue that, of course, not only Poland, not only Germany, but the world more or less is coping with and is a challenge. In an area of crisis is almost a buzzword these days, whether we live in a crisis or not. Certainly we do in certain regions of the world. Unfortunately, also a region that is close to us and even more closer to Poland, that's Ukraine. But sometimes I have the impression to put this on a global scale is a bit of a buzzword, and whatever, there are certain challenges in this regard. Tomasz is, as I said, a professor and also a lecturer at the Humanitas University in Sosnowiec, a member of the Tax Appeals Body in Katowice, a specialist in financial tax and banking law. But actually, if I see it correctly, his background is public law and not private law. I don't know how it is in Poland, but here banking law usually is taught by our colleagues from private law, even though it has, of course, a lot of components of public law. He is the author of a monograph on public funds as a source of financing political parties, and also co-author on another monograph on local government subsidies. So he has broad experience in the area of finance in a broader sense, and we will hear, and we are happy to have this opportunity to listen to some aspects concerning banking law. Please, you have the floor.
Thank you for your invitation. Thank you for introducing myself. I am really happy that I could come here, and I am really happy that I can tell you something about the banking law. As it was mentioned, I am rather specialized in the public law, but banking law it's such field that is a mix of both of them, because we have here both the national bank, we have the commercial banks, so actually there are the two components of the topic, and both of them are extremely important. I was trying to show you how it's needed to cooperate between those private aspects, but as well the public aspects of banking law. And of course, I was trying not to focus on the Polish market or the Polish system. I was trying to show it in a wider way, to show it as well globally. And the era of crisis is some part of the sentence, the topic that I added, because now we are living in such times that we have one crisis after another one, and we need to face them, and banks are such institutions that can both help in trying to make our economy better after crisis. Banks are such institutions that can finance some investments that are extremely important, and it's rather this private field. It can as well somehow try to protect economy from inflation. It's rather the public law, the central bank, but in the same time sometimes there is a risk that is not taking serious as it should be in the banking activity, and actually the crises sometimes are happening because the banks and their activities are not careful enough. But let's start from the beginning. So the introduction, something what is always the beginning of my lectures, because to understand this difference between the public and the private part of the banking law is to show this scheme that you can see now. So we have central bank and we have commercial banks, and their functions are different. It's not the main topic of our class, so I will today just briefly explain that a central bank is such institution that is responsible for monetary policy, for issuing money. It's such an institution that should as well supervise the banking sector, especially it should supervise the banking sector in case of crisis or potential possibility of bankruptcy of a bank, or in times where there is a danger that fiscal sustainability of all system could not work as it should. And in the same time we have as well commercial banks, and commercial banks are private ones. Commercial banks are rather connected with such banking activities like creating credits, like taking deposits, but as well financing, for example, some investments, financing infrastructure, which is essential as well for the country, for the growth of the economy. So let's start with something really basic. So the definitions, the concept of the bank. And I was trying to find one definition that would be correct for each system, but it's not such easy, because in case we are checking the European Union law, we have different definition than, for example, in OECD documents, or in the state definitions, I mean the rules of law in each state. So I decided to show you 4 of them that are important in the international way, because we have here Basel Committee on Banking Supervision, which is defining bank as an institution that is licensed to take deposits from the public and to provide credit. We have IMF definition, which underlining the deposit-taking corporations as a function of banks, which is as well connected with such functions like deposits payable on demand, transferable by check, or otherwise usable by for making payments. And there are other definitions from OECD, from European Union law. In general, they are similar, with just some small differences. But what I wanted to explain you as maybe some interesting fact, and it's the definition that we have in Poland as an example, because our definition contains everything what you can see on the slide. So it's the institution, license to take deposits, to provide credits, so everything is similar. But we have added, after the huge crisis from 2008, one special feature which is in the definition, in the legal definition of the bank, and this special feature is a risk. So we added that the banking activity is risky. Because we have a few types of the risk, and in general it is not possible to make this risk disappear. The supervision of the banking sector is trying to minimize it, to limit it, but it is never possible to cancel the risk 100% of the way. So this is the definition which is showing what the bank is, and another is functions of the banking sector. And here I mean all the banking system, both this private part, so the commercial banks, but as well the public one, so the central bank. It's easy as well because we have financial intermediation. It's connected even with the definition, because we know that banks are on the one hand creating credits, on the other one they are taking deposits. So there is intermediation between the lender and the borrower, between those who have money, want to deposit it in the safe place and maybe earn some money. Of course, it's connected with the interest rates that are in the moment present, and there is a lot of other functions connected with financial intermediation. Which is connected with it, there is a payment and settlement function. It's essential for companies, for enterprises, corporates, because this settlement function is helping to operate for those companies. The digitalization makes these operational systems easier. It's possible now to operate all over the world because we have online access to the apps, so it's possible to pay, it's possible to use other functions from any place in the world. It's just needed to have an internet. But there is as well a monetary policy implementation. It's connected with the central bank, and actually this monetary policy implementation is different, and it depends on the currency. Because if the country is a part of the Eurozone, there is a European Central Bank as one institution that is responsible for monetary policy in each country that is a member of the Eurozone. But on the other hand, in countries like Poland or Czech Republic, where we have our own currency, we have as well our national central banks, which are responsible for monetary policy implementation, and that's why, for example, Poland could had really fast action after inflation connected with the war in Ukraine, because our national central bank should focus just on the Polish situation. It was not needed to check as well the situation in other countries. So our interest rates increased because of the inflation, and this monetary policy started to work as fast as it was possible. And in the same time, when there is a mutual currency, so euro, it's needed for the central bank to check the situation in each country of Eurozone, because for one of them, it would be better to increase, for example, interest rates, like in countries in the eastern part of the Europe, like in Latvia, Estonia, Lithuania, because they all are part of Eurozone, but their economy is smaller if we compare to, for example, France, to Spain or even Portugal. And in the same time, the influence of the war in Ukraine was the biggest in those countries. But European Central Bank couldn't act just for those countries, because in the same time we had in Eurozone Portugal, Spain, Netherlands, so countries that were in completely different situation, because increasing interest rates could be harmful for their economy, while they didn't have such big inflation, because they are just a bit far from the war, so the influence wasn't such big. So the monetary policy implementation is another critical function, and here it's always needed to have balance between the economic growth and inflation, because the action actually has such responsibilities that on one hand it can decrease inflation, but it can as well limit the economic growth and opposite. The credit creation. Credit creation is connected mostly with investments, infrastructure, especially new technologies or some ecological parts of the economy, which are actually now the most important part to invest, and banks are the most likely to invest their money in such ideas. And of course, there is a risk management and fiscal stability as the last one, which are connected with all of the banks that we can talk about. If we are discussing the functions of the banks, and here we should think both about national banks or central banks and about commercial banks, it's as well a good way to try to affect on someone's decisions. It's not always working, but when the war in Ukraine started, one of the first sanctions that was made by European Union and United States was to stop for Russia possibility of using transfers with SWIFT. And it was one of such actions that were connected with the banking sector. And it was actually a big problem for Russian companies that wanted to operate, for example, with some European or American companies or corporates. But if we are discussing risk management, we need to show a few types of risk that we have in the banking activity. Those risks are, for example, credit risk or operational risk that are present in the banking activity. If you are discussing the credit risk, it's just the risk that borrowers that took loans are not going to pay it back, because, for example, installment is going to decrease because they are going to lose job, because the idea of the business that they wanted to set up didn't work as they suppose, and that's why they do not have possibility to pay this credit back. So it's such risk that is always present in the banking activity, so the credit risk. Of course, this credit risk is minimalized by checking and analyzing the business plans, the credit possibility, stability of work for such people, but in general it's not possible to limit it completely. After that, we have as well operational risk, so it involves the potential loss due to internal failures, like system breakdowns or some inadequate processes, which is happening, but it's not such a huge type of risk like a credit risk. And of course, banks, especially commercial banks, are companies or corporations that want to earn money, so they have partly as well connections with all market. So there is as well market risk, which is connected with the market conditions. When there is, for example, recession in main countries of the world, it affects for all markets, and it is as well such connection with the commercial banks. So such risk can, for example, decrease their capital, like it used to happen as well in the past. And of course, there is as well liquidity risk, and that's such kind of the risk that the bank might not have liquid assets to meet its short-term responsibilities, short-term obligations. And in general, if we are discussing the risk, it's something what is as well harmful for all the banking sector, because people sometimes are afraid to deposit their money. They are afraid during crisis to deposit money about the loss of them. And in all European Union, and as well in Poland, in Germany, there is such thing as a deposit guarantee system. And the minimum amount of money in this deposit guarantee system is 100,000 euro per person per individual. I don't mean here legal persons or corporations. And what does it mean? It means that even in case of bank failure, those people are going to receive money that were located as a deposit in the bank, even though the bank is bankrupt. So it should be a good argument or good feature of the banking system. Because I think there is not a lot of people with savings that are more than 100,000 euros per individual. So it's absolutely safe to have such money on your banking account, and that's one of the possibilities of the public system to check and to protect this banking sector. Of course, the supervision is essential as well, but here this guarantee is as well working for the minds of the people, so they are not afraid of losing money. If they are not afraid of losing money, they are more likely to set up accounts and to keep money on their banking account. But when we are discussing the risk, it's good to show the exact examples of these risky situations and exact examples of a huge crisis which was caused by the activities of some banks or some speculations. And here I need to explain about the huge crisis, financial crisis of 2008. It was it started in United States, but after that it spread all over the world. We had in Europe as well a huge impact of this crisis for our economy. And here in this 7 points, I was trying to show you how this crisis started, how was the procedure of trying to make the situation in banking sector, especially in United States, better. And after that, finally, how Europe, but as well all Western world tried to create such legal constructions not to happen something like this in future. So in the first point we have excessive risk taking by banks. It means that banks, especially in the United States, were likely to create credit loans as well to subprime borrowers. Subprime borrowers means that it was a high risk loans because banks were not checking carefully if such person is going to have possibility to pay monthly installment of a credit. They were not checking the capital of such people, and it was especially connected with mortgages and with buying houses, flats. And because those credits and loans were cheap and easy to take, it was connected with the increasing prices on the market. So it was this point too, so housing bubble, so rapid rise and collapse of real estate prices. There was really high demand for it, so prices were increasing. When prices were increasing, companies were building more, and after that banks were giving more credits, and it was changing really fast. The price of real estate could double even in 2 years. So it was obvious that it's just a bubble, but institutions that should supervise the market at that time didn't work correctly. Actually, that was the time of good situation in the economy. There was a huge GDP growth, and that's why everyone thought that we do not have any danger connected with it. Of course, some voices that it's a bubble and it's not going to work for a long time were quickly shut down. Why? Because banks were just making a great money for such operations. And what happened next? After that, in situation where there was, for example, one person with a middle salary that had 4 or 5 houses, each of them financed with the mortgage. After that, when houses was buying and it was just staying empty because no one was living there. After as well a little bit economy shut down. We had in United States, they had in United States a situation that the prices of houses started to decrease very fast because already no one wanted to buy credits was more difficult to receive. People were losing jobs, so it caused such a market situation that there was really huge amount of real estate on the market, and people were not more willing to buy it. So market mechanism was working correctly, so prices started to decrease. It was almost impossible to sell anything, so banks that was giving such loans or mortgages couldn't have their money back. And when it started to be a bigger and more common problem, they started to bankrupt. But before the bankruptcy, of course, they were trying to hide it as long as it was possible. There was a securitization of these bad loans. They were just packing it and selling as securities. As well, rating agencies had their influence on it because they received salary for the ratings that they were preparing. So it couldn't be shown for this institution as too risky, as a bad one. So these ratings were not correct. It didn't show the real situation. There was as well the weak financial regulations. The supervision institutions were financed in a bad way, so they didn't have enough money to check everything. And that's why this situation created a huge crisis. And as a symbol of the beginning of this crisis, it's said to be the bankruptcy of the Lehman Brothers, so one of the biggest and the oldest banks in United States. But of course, it's just a symbol because it started years before with the decisions connected with such bank activities. To protect all banking sector and savings of the people living in the United States and customers of the banks, federal government of United States started to transfer billions of dollars to the banking sector. So for this irresponsible actions of the banks, just taxpayers paid because of course federal government had the money from taxes, and those huge money that wasn't planned to transfer for banking sector create as well a huge problem in all public finances in United States. This was one of the reasons of the recession in United States, and after that, because it's the biggest economy in the world, it spread for all over the Europe, as well Japan, Asia, so all over the world it spread the crisis. So now what were the main effects of this crisis? Of course, global recession, which I already told you. Just in the United States, there was 8 million people that lost jobs, 6 million people that lost houses. And in general, even though we had such a huge crisis, there was no criminal reaction. So actually, any of those persons that was responsible for it went to jail. It was just made very silent and finished without the real responsibility for it. The mass unemployment, yeah, as I told you, it's just United States. 8 million people lost their works, and recession was as well in almost all Europe. As I remember the data, there was just one country without recession. That time it was Greece, which after that had really great, huge troubles, and all Europe needed to help because they were just one step from the bankruptcy as all country. Of course, occurred the credit crunch, so it was more difficult to create credits, to invest. So public debt increased as well. It increased because of the money that were transferred to the banking sector. But if we would try to find something good in it, after this crisis we have tighter financial regulation, especially in EU. It was the Basel III document, and stronger supervisions of banks as well in Poland, in Germany, as I checked. After the crisis, banks were much more carefully checking everyone that wanted the loan. And after that, what we have is something good to say about banking sector. So how it was influenced in a positive way in connection with the war in Ukraine or the post-COVID-19 crisis, because I don't want to tell you now that banks are terribly bad, because it's not true. I just want to show you both sides of this, and how the banking sector can help stabilize and revive the economy during crises. So these credit creations and liquidity supports are extremely important, because credit creations, especially if we mean investments, is helping to grow for the economy. Such investments are giving jobs. Such investments mostly are working for the future wealth of the country, and some of them, in some countries, most of them are financed with the money from the bank loan or credit. When I am explaining this credit creations connected with the supporting for the economy, I have example connected with both Poland and Germany, and it's example with the airlines, the Condor Airlines, which were German, and in 2019 all of those airlines was said to be sold. And the Polish LOT Airlines wanted to buy all this company, and it should be that time a huge step to spread this activity of LOT Polish Airlines as well to charter flights, the holidays flights. There were 3 huge banks in Poland that wanted to take the risk of this transaction and that wanted to finance it, to create such huge credit for the LOT Polish Airlines, because they saw the possibility of having a huge income from this operation in future. But as I think we all know, it was the end of 2019, and in 2020 the COVID pandemic started, and finally this transaction never happened. Finally, because of the changes of the circumstances, the changes of the real situation, Condor haven't been bought by a lot. Even though it was already almost finished, because the financing was already provided by those banks. And after that, there is a monetary policy transmission as the second way that banking sector can help to stabilize situation, because these commercial banks are implementing the central bank policies. When you have shown the percentage of deposits, but as well of loans, credits, it's all connected with the decisions of the central bank. So they are implementing it, and they need to focus on the main responsibilities of the central bank. So to decrease inflation, or just to have inflation in target. This target is 2.5% for European Union, and there is possibility to have it between 1.5 to 3.5, which is set as good inflation in target of European Union. There is as well financial intermediation and confidence restoration. So the stable banking operation are rebuilding the trust in the financial system. And the trust in financial system is extremely important, because if there is no trust, for banking sector, if there is no trust for financial system, it is limiting the possibility of economy to grow. Why? Because if people are not willing to deposit money in the banks, if they are not willing to create credits, to take loans, it means that the economy is not growing as fast as it could in the way that the banking sector can provide it. After that, we have counter-cyclical lending, so continuing to provide credit during downturns, because especially during downturns, the states are creating bigger deficits just to try to finish those crises. It was like this, for example, during COVID pandemic. So we created a huge deficit in the countries, and this deficit was spent mostly to protect the jobs places, to protect some enterprises, especially small and medium enterprises. And even in the situation of a bad structure of the market, banks should continue this policy as a even counter-cyclical lending. And of course, support for fiscal measures, like a distribution of government support, such like dotations, grants that can be received by both companies and institutions, like even universities or some public offices. It's all connected with this contribution that is made by banks. They are making it much easier, faster, and just better for the people that are connected with it. And something more specific, because of the COVID pandemic crisis was making the recession all over the world. Bank played everywhere the essential role with the need to protect the economy. So this rule was, for example, connected with distributing these government guaranteed loans to companies, but as well to states, because here I have example of United States paycheck protection program, but in European Union we had as well such programs for the help for the states, not only for companies as it was in United States. So this temporary framework for state aid was as well some solutions that should help in stabilizing the economy after pandemic, but first the credit creation was needed in such a huge way that it haven't done before. The second one is that central banks provided liquidity through low interest refinancing operations. So when, for example, banks wanted to have their installments paid back by borrowers, it was impossible for some of them, for example, when they were losing jobs or when their companies couldn't operate because of lockdowns. And in such ways, central banks made such decisions to refinance such low interest rates for some operation, for some companies, for some sorts of the economy. And the third point, banks restructured existing loans and deferred payments to prevent mass bankruptcies. It's as well essential one, which is connected with facing the real situation all over the world. And if banks didn't do it, probably people could again lost houses, lost their jobs, and the effects of the COVID pandemic would be even bigger than it actually was. And the war in Ukraine, and here of course it affects most of our part of the world, but I would say that the countries that are the closest to the war feels this effect much more, so like Lithuania, Latvia, Estonia, Poland, Romania. For us this effect is really significant, and it's uncomparable, for example, with mentioned already countries like, for example, Portugal or Spain. In this situation, banking sector has as well the huge influence because the European banking sector supported refugees, affected firms with special credit lines, gave some possibility for cross-border transfers without fees that normally was needed to take, and this was the huge support, especially for those people which actually we were calling our guests in Poland, when we had, after 2 weeks of war, 8 million people from Ukraine present in Poland. This rule of banks was really essential because they came sometimes just with some Ukrainian money in their pockets, which actually on the market means nothing. They were already worthless. And that's why without such support of the banking sector, it would be difficult just for them to survive those times. But central bank strengthened as well the financial stability mechanism to absorb shocks from energy prices and sanctions-related disruptions. It's as well essential for the economies, especially that European economies, at least some of them, were really close with energy from Russia. The oil from Russia was essential for creating the economic growth, for operating for all industry. So the role of the central banks to make very fast action and to make division and change of this was as well essential. So without it, most likely after this situation in which, for example, the oil stopped to come to Europe from Russia via Ukraine, without such cooperation for the European economy, it would be even more harmful than it actually was. And development banks increased investment financing in energy security and infrastructure, reducing long-term vulnerability. It's another really important part of the action. It's all, of course, connected to change the world economy, because there is no industry without energy. There is no economic growth without modern industry, new technologies. Sometimes the sanctions or some embargo that was made for both sides created huge problems for some enterprises, corporations. And there was as well the rule of development banks to increase investments and try to change it as fast as possible. And now we come to conclusions. There is 7 points that came to my mind after preparing this presentation as conclusions. So definitely banking law and in general banking sector plays a stabilizing role during crises by creating a framework that protects the integrity of the financial system and public confidence. But we need to remember as well that such risky activity can be as well harmful, like the great crisis of 2008 showed us. So this crisis proved that unregulated or weakly supervised banking sector can become the main source of instability. Effective legal regulations and supervision are essential, and I think that's the lesson that we already made after the crisis of 2008. But of course, some regulations didn't work, especially connected with the fiscal sustainability. We have such regulations in European Union connected with the public expenditures, connected with the limitation of debt, of deficit. And we thought that it's going to work during crisis. It was created after the great crisis of 2008. But unfortunately, when COVID pandemic started, we could recognize that no, it doesn't work. These scams that was implemented there was too weak for such huge crisis that we truly had. So that's why one of the first decisions of European Commission was to stop a mechanism, for example, connected with the limiting of public deficit. Another conclusion is the crisis exposed gaps in legal frameworks, and these gaps I told you about a minute ago. So sometimes it's impossible to predict what is going to happen, especially in economy which is connected with such natural crisis like COVID pandemic. But such reforms, especially in capital adequacy, liquidity requirements, consumer protection, are absolutely essential for all the banking sector. And another one, cooperation between government, central banks and commercial banks ensures liquidity support. So another factor is maybe a bit political, because sometimes there can be some different voices from government and from central bank. Such situation is never good for the economy, because normally central bank should support the government policy, but if central bank finds the government policy as harmful for economy, or if it is found as creating inflation, the central bank can stop supporting the government economy. In such situation, it's as well challenging for the situation. So this cooperation is absolutely essential, especially during crises. And there are three words that I am always underlining. So it's stability, flexibility, and balance. Because in some actions connected with the public banking law, so for example interest rates, they need to be balanced between two values, so lower inflation and fast GDP growth. There need to be balance between, for example, income and the risk. So the balance, really essential word. Flexibility, because banking sector need to be flexible. Banking sector should have such possibility to fit into the situation that they are in. And stability. Stability understood as the capital of the bank that gives them stable situation to operate, stability of the state budget, but as well just the market stability. So those three words are here essential as conclusions. And the last one, so after crises, each of them we explained, so 2008, after that COVID, after that war in Ukraine, all of them shows that the evolution of banking law toward greater prudence, transparency and social responsibility is needed to be done all the time. It's not that we finished one crisis and after that we are trying to implement some new rules and we can wait for another crisis without action. It's needed to do it all the time, to try to find out what can be a new danger for market, for banking sector, for economy, for the state, and trying to predict it and protect economy from such result that we could see in Europe after each of those crises. Of course, it's difficult. Maybe even it's impossible to do it completely. But if we are limiting it, if we are prepared for it, if our finances are stable, are flexible, and we have a good balance between values, in such case, we can have a huge hope that the crises that are going to happen in the future, because it's normal in the economy, will not be such a terrible experience for both corporations and companies, but as well for individuals, and of course the state, which is connection between all of them. And for now, it's all. I would like to thank you one more time for coming here, for listening to my lecture, and I think we are going to start the discussion soon, so thank you.